G'day guys, welcome to Buy and Sell Zones. My name's Andrew Blackburn, I'm the host of this channel. I'm from Brisbane, Australia. A big g'day to everybody out there. Now, as you can tell from our name, our main focus is on the principles of supply and demand and how to identify key buying and selling zones in the financial markets. Whether you're a brand new trader, just starting out, or you're an experienced trader just looking to refine your skills and find an edge, this channel is for you. We do not offer any financial advice. Now, my own trading journey has been challenging on so many levels. Not until I came across supply and demand did my results start to improve. Now I'm very consistent and I believe enjoy an edge. In the first video, I'm excited to have Sareed Harper from Hypnotic joining us to talk about his supply and demand software. Now, Sareed has an extensive experience in the financial markets. He's an expert in identifying key supply and demand levels. He'll be sharing his insights and explaining how his software helps traders make better trading decisions. Now, just before we dive into the discussion with Sareed, I'd like to emphasise the importance of understanding supply and demand in the financial markets. Now, the principles of supply and demand are the backbone of all market activity, and if you understand how they impact price movements, it will give you a significant edge in making your trading decisions. That's why I created this channel, to provide traders with a comprehensive education on the subject and equip them with the tools and knowledge they need to actually succeed. Now, we're going to have weekly examples of winning trades, and we'll discuss different strategies throughout that period as well. By using Sareed's supply and demand software, traders can identify key levels of support and resistance and make more informed trades based on market conditions. You don't necessarily have to use this software, but I've found personally that it's just given me an edge, and I'm not spending hours and hours and hours looking for these levels. So without further ado, let's join Sareed and learn about his software and how it can help you and traders generally make more profitable trades.
We are going to show the supply and demand software, and then we'll also maybe have a peek at the currency strength software today as well, depending on how we're doing on time, because things can drag out. But the supply and demand is pretty straightforward, and it's the supply and demand software that the currency strength software that can sometimes get a little bit dragged out. Let me change these colors here. You can see. Okay, good. Excellent. Okay, so very briefly in regards to the indicator and what it's doing. What it's doing, it's looking at historical price levels, and it's looking for imbalances in supply and demand. And this is interesting because it enables you to spot the points in the market where price is most likely to turn around. And you can see, we have a nice one here. Actually, I better turn this stuff on so we get some. Stuff. You can see that we have this area here. The indicator would mark this one off. I've disabled the functionality for the time being, but this is nice. We had a decent area of demand here, and this is demand because it came down and it left very quickly, and price hadn't looked back since then. And here we have a parent. We have also an independently established area of supply here. So this is a parent, this is a parent, and this is a child because this is reacting at this one, and this is a child here reacting at this one. And then price left. And when price left here, we managed to wriggle up nice and efficiently. Efficiently meaning that when the price imbalance that it created, like when price left departed from here, it moved higher, it rebalanced this, it went up, it rebalanced, it went up, it rebalanced. This is nice, efficient trading. So this is nice strength. This shows a lot of strength as price is crawling up nice and evenly and balanced. And so price is not really a disparity, but when it came up here, you can see that we managed to move higher than this parent, which is good. So that shows us that the initial area here was strong enough to consume these opposing children's supply and this parent just here. So this tells us that we have a pretty decent area just down here. So price came down on the first test. We touched the wicks once. We established this child area. Price reacted at the child, forming another child, and then we managed to kind of feed into the area, into these wicks, and eventually cut through this area of demand. And you ask yourself the question, what area of supply consumed this demand? Well, it was this one just here. And if we take the wicks like this is pretty much where price came to before it released. So you have to identify the area of supply that managed to consume the opposing demand. Let me let David in here. Okay, I've muted everybody now. So if you want to say something, just let me know in the chat box, and I'll unmute you. If you guys jumping in here, cool. And so this is why I've also enabled for the manual drawing of these areas of supply and demand. So it's pretty straightforward, really. But what we're going to do is we're going to have a quick look at the configuration of the indicator, and we're going to walk through it. And I'm going to explain all of the settings, and then we'll kind of switch stuff on. Then we'll discuss the functionality step by step. So if we have a look here, the functionality is pretty simple. There aren't a whole lot of settings here. Most of them are. I mean, we have a lot that are related to color, which we'll get back to in a little while. But we have the enable the dashboard position, and this range information. This is related to here, to this dashboard that you can see here. So this is what I'm calling the dashboard. Let's load these guys in. Okay. And so what we can see here is we can see a market flow on these different time frames. So on the monthly chart, we have market flows moving down. On the weekly chart, we have either a pennant or a megaphone formation. So we don't have any clear higher highs, higher lows, or lower lows and lower highs. So we're waiting for clarity. But on the 4 hour and on the daily, price is moving moving higher very nicely. And on the smaller time frames, things are kind of drifting sideways, also in either pennants or megaphone formations. And we have range information here. We have the D1. So this is 5 days. This is the 5-day average daily range, 36. And this is what this pair has done today. So we've actually exceeded the 5-day average daily range by an awful lot today. So price really stormed today. You can see here very clearly. And here we have the weekly. So we have 4 weeks. So 5 days make a week. 4 weeks make a month. This is a 4-week average daily range. Today we've exceeded that. Then we have the month, which is 12 months in a year. 12-month average monthly range is 340 pips, and so far we've done 262. So this is just showing us a little bit about the strength of these moves. You can see that today we blew everything out of the water. For this week we've done that as well, and we still have a bit of space left on the monthly chart. Then you can also see that we have the color here, which is green. And what does that mean? Well, this currently tells me that the interest rate swaps between the New Zealand dollar and the American dollar, they are in favor of buying this currency pair. So assuming that we buy, let's say, 100 lots of Kiwi American dollar and price moves sideways, it doesn't do anything, it just moves sideways, we will be earning money every day when the clocks strike, rather when my broker tips the clocks at midnight, then I'll be earning a little bit of money per lot, typically a few dollars per lot. But if you're trading big positions, then this can essentially result in a pretty high yield. And for the time being, we have the Kiwi, which is the highest yielding currency. And if you pair that with some of the poorer yielding currencies, then you're going to have what's known as a carry trade. And so this just gives you a visual indication of if you have a positive carry or a negative carry on your trade. And so if this was red, that would mean that we would want to sell if we want to carry the currency pair over a course of the next 24 hours. And so you don't have to pay attention to this, but if you're trading huge positions and you're holding them for weeks and months, I mean, this can mean an awful lot of the bottom line. But for day trading, kind of shorter term, maybe swing trading, then this may be not so important to you. But so this is a little bit about that information. I like to see this information, especially the daily range. If London is closing and the pound American dollar has reached the range, well, I'm going to feel pretty comfortable about selling or buying, so that price has to bleed back into the range. And that's just generally a pretty good idea, especially if this happens as supply or demand. Okay, so that's a little bit about the dashboard. Hi Rakesh, good to see you here. And then we have another setting here, round numbers. And this is interesting because this enables you to view psychological numbers in the market. So if we enable this, we go down to a smaller time frame, you can see that we have these red lines, and these are at multiples of 100 pips. And this is a beauty because you can see at the very bottom of this area of supply, we overlap nicely with the big figure, the 7,400. The price came up to that area and then it dumped. And here we have an accumulation candle. Towards the bottom of this accumulation candle, we overlap nicely at the big figure, the 7,200. Price poked up to it, it found some liquidity, kind of the mid area of this accumulation here, then it dumped. And you can see actually how price just respects these levels. It's pretty phenomenal actually. You can see how price rallies up. We poke down into this, we come up, we stall at the big figure, we cut through it, we go to the next big figure, down, up, down. You can see how it just bounces between these lines here. And so it's just a good idea. You know, you don't have to leave this setting on the chart because it can get a little bit intense and perhaps a little bit cluttered. But you can just kind of keep it in mind. So when price reaches an area, just kind of make note of the price level. And you'll find that a lot of the really good areas are often occurring at the big figure. And so this is just another reason to feel confident about taking the trade. So that's just a nice feature that I've decided to add there. We'll just turn that off for the time being. We have the round number. Line width, you simply specify the thickness of this line. Okay, and then we come down to the supply and demand functionality. Let me get that there. Okay, so we have the setting here, enable supply and demand analysis. We'll set that to true. We have something here called supply and demand significance, and this tells the indicator for what number of periods to the left and to the right the area of supply and demand has been respected. So we have had no closes through and beyond the area for 5 periods to the left and 5 periods to the right of an area that is to be qualified. And the higher this number, the more significant the area. So if this is on, for example, 100, we'll just do that. First of all, we'll just turn it on to 5. We'll just leave this on this time frame here. You'll notice that we have quite a few here. But if we turn this value up, we put it on, for example, 50, which is a big number, you'll notice that a lot of these levels are going to disappear. And we have this one, which is a whopping great level. We have this one here, which is another whopping great level. Price touched it, went down to them. We have the other one, which is at the top here. And so these are going to be levels that price is very likely going to have a tough time moving through. You can see here, we had this one here, this was actually established. This was visible on the chart. Here, you can see 50. So when this candle closed, this rectangle was drawn on the chart. And so you knew about 100 weeks or 2 years in advance that you wanted to be selling up here. And the indicator told you that you had 2 years prior to price getting there. So that's just a really nice feature, I think, to have. And so the indicator is drawing these levels, and if they're nicely qualified levels, well, then you have a lot of time to ooh and ah about the trade and follow up on the fundamentals that are driving the market in order to assess if you want to take the trade or not. So it's just a really nice indication. You can see here we have another area. Price didn't release as nicely as it did here or here, but we had price left the area and we managed to hold away from the area. So price has not been back to this level since. Hence, this area will likely hold in the future once price returns to it. So, yeah, this is of course applicable on all time frames throughout the entire, on any time frame. So if we have a look here, we set this down to a normal value. I normally use between 5 and 10 or something like that. That's a pretty decent area. I know Michael uses 10, but you can kind of fiddle around with it and use something that makes sense to you. But if you're putting on, for example, 1, you'll notice that things get really noisy. And so it's a little bit, oh wow, is it this one or this one that's important? And so you want to perhaps set this to a value that has a relatively high degree of significance. And I find that Yeah, at the very least 3. 3 is also pretty low. But yeah, 5 is generally a pretty decent area. 5, 8, 10, something like that. And so here you can see we have some pretty decent areas. This tiny little area here was respected very nicely, and then price went north over the course of the past couple of days. Okay. And then we have this one here, show compact supply and demand levels. If this is set to false, you're seeing these rectangles being drawn, and these are extended beyond current price, which is nice. But if you just want to have like a rough idea of where these areas are without maybe wanting to pay too much attention to the specifics of these areas, then you can simply set this value to true, and it's just drawing these check marks, which is showing you where they are. So we have one here, here, here. We have a couple here. Here we have the parent, we have the child just here. And this is just showing you where these areas are without drawing these rectangles, which can also be nice if you're worried about your charts being cluttered. I like to have them on my charts because this gives me a visual indication about these levels, but also the rectangles themselves, they contain information about position sizes that I'll show quickly. If you hold the mouse over this, for example, you can see that it says, based on this account size and a risk of, I think it's .25% of risk, this stock was going to be 7 pips, and the position size is going to be 35 lots, 0.4 micro lots. So this is just a really nice feature that I've added. I could also actually add this to the check marks. Perhaps I'll do this in a future release. But for the time being, they're only on the rectangles. And then we have this setting here, which is also pretty useful. Show consume supply and demand. If you set this to true, and it's going to show you where previously existing and now disqualified areas of supply and demand are located. So you can see that we had some supply up here. This was disqualified by this one here. This one was disqualified by this one here. This one was disqualified by this one here, and this one was disqualified by this one here. When price left here, it moved above and beyond, taking out this one here, telling us that this is a pretty decent area, because when price left here, we managed to move below this one here, which is also a decent area simply by the structure of it. We had a trend line break as well. It's something like that. So market structure failed once price managed to move above and beyond the trend line, and so that qualified this is a pretty important area of demand. And price went through this. This is the area that did it. This is the one we can expect price to react on, and it did so here and moved lower. And so these areas are all linked together, which is what I've tried to kind of specify via the functionality of the indicator. This just makes it pretty clear what's going on. Okay, great. And then we have supply and demand width, which is simply the thickness of the rectangles and the lines. Then we have greater period multipliers, and this is a very important setting. Currently it's set to 0, which means that the indicator is looking at the current time frame plus 0, which means that the current time frame is 4 plus 0 is still the 4 hour. But if we put this on, for example, 1, then it's going to look at the current time frame plus 1, which puts us on the daily chart. So if we're on the 4-hour chart and this is set to 1, then we're going to say we can see daily levels on the 4-hour chart. And here you can see the consume supply, consume demand, consume supply, consume demand, and existing and valid demand here. This is really cool because it enables us to have a pretty good understanding of these major areas simply by setting this to the time frame bigger. So if you go to the 1-hour chart, you'll see 4-hour levels. If you go to the weekly, you'll see monthly levels. The daily, you'll see weekly levels. And so it's just a really kind of a crisp way to view more significant areas of supply and demand. And it's a very visual and I hope pretty intuitive tool as well. So you'll also notice that a lot of these levels are color coded. And this is simply to help me differentiate between the different time frames visually, but I'll come into that in more detail in just a second. Okay, so if we go back here you can see that we have the greater periods is set to 1 now, but wouldn't it be nice if you could view the current time frame plus 1, and the current time frame plus 2, or perhaps the current time frame plus 1 and 2? Well, then you would simply put a 1, comma 2. So now you're telling the indicator that you want to see the current time frame, which is the daily, plus 1 is a weekly, and plus 2, which is a monthly. So on the daily chart, we're going to see weekly and monthly areas. So if we just switch that on like that, then you can see that we have a whopping, we have this purple level down here. This is of course plus 2, then we have the plus 1, which are the orange lines, which are the weekly. We go to perhaps the 4-hour, we'll probably see some, yeah, here you can see we're on the 4-hour chart. We have the daily, which are the red ones, and the weekly, which are the orange ones. And this is great because when you can see them like this, you can see they're all nested and cascaded over on top of one another. This tells us that we have a weekly area, and within that we have a daily area that's kind of nested inside it. So this just gives us like better confirmation that we have more significant areas that we can consider to trade. So this is a pretty cool feature, and if you want, you can also put like 0, 1, like so. Then you'll see the current plus the 1 and 2 like that. But you can also do something that's pretty awesome, my humble personal opinion, and this is you can go time frames down. So assuming that you like to trade on the daily chart, wouldn't it be really cool if you could look at time frames, one smaller than the one you're looking at and one bigger? So you can go -1, comma +1. Let me go to the daily chart. Let me remove the consume because that looks a little bit messy. And then you can see here very, very clearly that we're on the daily chart, and we're seeing 4-hour areas of supply and demand. So we have these really nicely nested areas. You can see that we have a weekly area here, and inside that we have a 4-hour area of supply at the lower end of it, which price touched on to the pip, more or less, and we have another one at the top here. So this gives you incredible insight into what's going on inside these areas of supply and demand, because if you're trading on one time frame, sometimes it can be a little bit perhaps challenging to nip into the smaller time frames to identify these micro areas of supply and demand. But now the indicator is doing this for us, and it's showing very clearly where these areas are located. And this is just a prime example of that, this 4-hour area of supply here at the top. And you can also see here that we had this area of 4-hour demand, and price came down and poked into it. So the daily demand would have been located like around here, and price went through that, and it was seeking the liquidity that was located inside that towards the bottom at this 4-hour area of demand. So a really nice example of that. And I know an individual who uses this on the small time frame. He's a short-term trader, a scalper, and he sits on the hourly chart, and he's looking at these areas like this. So he's buying these micro areas that are located, excuse me, within the smaller time frames. And this would have been the exact trade that he would take, and he probably took this trade today. Actually, we have a really nice rally, accumulation rally, a really strong release. We had this area of demand, but price went in to the very bottom of it and found this half-an-hour area of demand inside this this nice accumulation just here. And so the pip risk here was 2 pips. So on this account, 1%, 122 lots. So I mean, price doesn't have to move very far for you to get a 2-to-1. It has to go 6 pips, and you got a 3-to-1 reward risk. So this can be a tremendously valuable tool on any time frame. And if you want to get really nitty-gritty, of course, you can put this down to -2, but then things get really cluttered. So just kind of experiment with that a little bit, but I think that you'll find that the settings are very useful for doing what we've discussed just there. Okay, and then we have this setting here, the manual bar count. And out of the box, the India does a pretty decent job at identifying how far back it has to go in order to begin the analysis. But sometimes if price has been trending for a very, very long time, you might want to view a little bit more price action than you can see on the chart. And so this setting here, manual bar count, enables you to specify that number of bars. So when it's on 0, it's doing it automatically, but you can set it to, for example, 1000, and then it'll go 1000 bars back on the current time frame. But remember, when you start specifying this manually, the indicator can sometimes work a lot harder than it otherwise would. So if you have like 7 or 12 or 30 instances of the indicator running and you specify this manually, then you'll notice your computer slowing down to a grind. And so just be a little bit careful of that if things start to slow down a little bit. I always leave it on 0 because I think it always seems to figure that stuff out pretty nicely by itself. David Bush is asking, Sarit, if we have a question regarding this stuff in particular, do you want us to wait until the end to ask? No, you can ask them now, David. That's perfect. Then we can take them as we're going along. That's completely fine. I'll just wait for you to put your question in there if you have one, and I'll move on in the meantime. Yeah, so that's what we have there. That's the supply and demand. Then we have the trend line functionality. We have this. Let me turn this off so for clarity. Then we have enable manual trendline management. If you set this to true, the indicator will start looking for objects that you draw on the chart. So, for example, if you want to draw an upward sloping trend line, you would use the 2 most recent clear swings. We have a low here and a low here, so we'd connect this one to that one. And when you let go of it, the indicator will grab it and it'll color code it. It colored it blue, and this is because this is a 4-hour color. So when we go to, for example, the hourly chart or the 50-minute chart, we notice, hey, we have a blue trend line. That means that this was drawn on the 4-hour chart. So we have a really nice way of maintaining oversight over the higher time frames simply by using this color-coded functionality. Okay, David has done his question here. Is the manual bar count field the same as the supply and demand bar count settings? Let's have a look. Supply and demand bar count. Yes, actually, I think this is probably because you're using a slightly older version. That's exactly why. I have been doing a lot of performance improvements over the course of the past maybe week and a half, 2 weeks, and I've solved a lot of the challenges that I was struggling with in the previous build. And so I've changed a few things, and some of the names have been changed. Also, extended range candles are now called enable imbalance bars. I'll probably change this to enable price imbalance bars for reasons I'll explain when we get there. And so, I'll send a link to Michael today, and he'll distribute the link, and then you guys can download the newest version. So it runs a lot faster as well. So I hope that you can appreciate that as well. Rakesh is asking, Sri, according to how we learned to draw the supply and demand zone, it doesn't seem like the auto supply and demand boxes allow for those rules. Do we need to manually adjust? Good question. The reason that sorry, let me go back to that. The reason that the indicator is drawing them like this is because this is, you have the accumulation. So you find the candle that leaves, and then you go back and you ask, is this an accumulation candle? Yes or no? No, it isn't. Keep going left. Is this an accumulation candle? Yes, it is. Great. Is the range of the body within the range of the previous candle? No, it is not. So this is the demand here. So typically you would mark it off like that, but the indicator marks it off differently. And this is because it is taking the bottom of the body. And I've done this because research has showed me that price often goes down to this level very, very often, more so than it stops here. And so this is, I'm showing where these areas are, or the software is, and it's up to you to either take the more conservative approach, which is what the indicator is showing you, or to take the more aggressive approach, which is drawing it by attaching the rectangle to the high of the body of the accumulation candle, which is just there. And this is just an example of price going through the body and going into the indicator line, but it could equally have been the different way where price. Let me see if I can find an example. My price. Let me. No, I didn't enable it. Good. My price went to the edge of the box. You can see here, I mean, the indicator drew it here, but price, where did price go? Well, we have the candle to the left, and it went to the highest body of the accumulation, which is this one here. Go on. And it poked into that, and that's where we saw the reaction. And yeah, so if you would have waited for the cheaper price, you wouldn't have got filled. But it's just kind of like a personal call. I like to wait for price to come here, but again, it depends on price. When price is racing up like this, it's probably not going to necessarily come back to the area. As you can see, this one didn't, this one didn't, this one didn't, this one did. If we look at the time of day, it's probably it's in the morning, so this is before London opened, and so price is normally drifting sideways, and so price will often come back before sessions and after sessions. During like prime trading, price will sometimes come back. Here we're in the Japanese or the Asian session. Here we are, I don't know, some other session, I'm not sure, but you can see that price is moving up pretty strongly, and so price will often come back to the body of the accumulation candles and continue from there. But there isn't a one size fits all. It's just something that a bit of experience behind the controls will help you understand. David is asking, so you would consider the close of that candle as the entry point rather than this high or open of the prior candle on the demand zone? Yes, I mean, for this one, this is of course like the cheaper one, and this one here is the one that price managed to react at. But you can also see here that when price leaves, it'll show you where the edge of the area is, and you can see when price left, price poked back here, and so you do not want to pay a price for this, for the Kiwi American dollar. If when price is here, you don't want to pay a price any more expensive than the 770.10 area, because price has already come down to that level, and that's roughly where it came. It had a poke a little bit deeper, kind of seeking the thick liquidity located in this accumulation. This is where we saw the reaction. Yeah, a bit of practice, and you'll be doing really well with this. Okay, let's continue nipping through the configuration options. So we have our trend lines, and so when this is set to true, it's going to look for trend lines that you draw, and these can be either horizontal trend lines or diagonal. Let me turn off supply and demand so we have a clearer picture. And this is important because we use these to qualify areas of supply and demand. So if price is reacting at an area of supply like it is doing, we're going to use this example because this is a good one. So we could have marked off, for example, we had our trend line, we marked off from this low to this low. Price managed to close below this trend line. What does that do? Well, that qualifies a couple areas of supply here as supply. And so supply up here caused market structure to fail. And what is market structure? Market structure is simply the use of trend lines to define respected lows or respected highs. You can see price came down to it. We had a small reaction, then price cut through it. So this area of supply caused this price structure to fail, and it originated from here. But you could also, for example, have, let me find an example. You can have this one here, where price came up here, we kind of tested this area for a while, we failed, we tested it a bit more, and we finally broke through it. So here we had a horizontal trend line break, and here we had, sorry, a diagonal trend line break, and here we had a horizontal trend line break. And the break of the trend line originated from this area of demand down here. The imbalance originates from here. We have agreement in supply and demand, we have a disagreement. So we can expect, this is a 5-minute chart, so it's a little bit messy, but you can expect that something is going on in here. So price will probably react down there at the 72.40 area once it returns. Let me enable the rectangles. We'll cover those next. Like that. So the 72.10, you can see that we caused this trend line to break, and this is the point of origin for that move. Price went up, we tested the area, then it went higher. So price has already been back. What does that tell us? That tells us that price is probably going to go at least as deep as this on the next approach. In this chance it didn't. We reacted at the child, but theoretically speaking, when price comes back to an area, the low of that area is the area where liquidity has been thinned out. And so the thick liquidity is below the low, below the test. So we expect price to come to at least to the lows of this test of this area of micro demand here. Okay, so that was the diagonal on the horizontal trend lines. And again, you go on these bigger time frames, you can see we can still see them here. That diagonal trend line is a little bit difficult to see, but so I mean, if you identify these on the bigger time frames, it's just nice to be able to see them on the smaller time frames. So you know that. Let's find a nice example where you see how price kind of couldn't close above that area, and then price finally managed to close above that area. If we come back to that level, I like that one better because it's been respected here and over here. It changes the color, 70-40 area, cuts through it, we test it, and then we go north. So when you're on the hourly chart and you see that line, you know that, okay, that was that weekly area, the weekly horizontal trend line break. And you can see where that is. And so you know this was drawn on the weekly chart, which gives it a significant amount of clout because it was drawn on the weekly chart. And so just again, it's just a nice visual way to see what's going on all the time frames without having to leave the current time frame. Okay, so we have enable manual trendline management. We also have this enable automatic trendline management. If you set this to true, then the indicator is going to start looking for these levels itself and drawing them. So I'm just going to remove all of these, and we'll click through the charts a bit, and eventually it'll start drawing. Yeah, we found one here, a trend line here. And this is not a qualified trend line point because ideally we have a low, we have a high, we have a higher low, but price has not moved above this high. So this is not properly qualified, but it's drawing it at the earliest possible stage so that you can, so you're aware of where the trend line will be drawn from. We have another one here. This is properly qualified. We have a high, have a lower high, and then price moves below this low. So this is qualified. On the hourly chart, we have nothing. On the 4-hour, we have this, which is beautiful. This is the one we drew earlier from this low. We have a low, high, higher low, higher high. So this is qualified, and this will, if it overlaps nicely with this, here we have a diagonal trend line break. You can see we had price testing at these areas for a while. Test, and then price cut through. This tells us that we have a really nice area of demand here, which originates in the 72.23 area. And if it looks like if it overlaps nicely with this 4-hour trend line, I mean, that would be another reason to buy there. We have this horizontal, the horizontal horizontal trend line break, upward sloping trend line, telling us that we have a 4-hour uptrend, and we have this demand that broke, caused market structure to fail just here. And so this is just a really nice way to kind of mark up your charts to help you qualify them using trend lines. And I mean, if you leave them, if you let the indicator draw them for you, it's not going to find all of them, but it's going to find the ones that are very, very apparent and very clear. Okay, so let's have a look a little bit further down. We have this one here, which is enable trendline management. And this is simply, this tells the indicator to look for rectangles that you draw on the chart manually and grab a hold of them and change their appearance. So add a color and add a label, a few labels to them. So if I set that to true, I'm just going to have a quick look at the other settings before we press OK. Filled rectangle, I mean that would fill the rectangle with a solid color. But as you'll see, it gets pretty massive, a little bit intense. I'll just enable that for you so you can see it. You can see it gets pretty hefty. If we draw this one here, like so, you can see that it gets a bit intense, but some people like that. Then they really jump out at you, like so. But I like to keep those. I like to keep this on false because it just makes things a little bit more clearer when there we are, when you can see through them like that. Then we have some other information here. Of course, we have the rectangle border width, which is simply the thickness of the rectangle. We have the extra capital and risk. So risk tells us how much we're risking per trade. So on this account, we are risking 0.25%. And this account is maybe 980,000, I think. And so the stop here is 24 pips. At 0.25% of 980,000 bucks, we are allowed to trade 10.22 lots. If our entry is at 72,232 and the stop is at 71,987, then I mean the math is done for us, so we don't have to guess when we're calculating position sizes. And this one here, we have a small area here. If we're buying just above the big figure, we have our stop at 69,887, and we're allowed a position of 12.91 lots. But if you change this to, for example, 1%, then you'll notice that this will go up to 40.888 roughly. Let's see. 40.888 exactly, which was 4 times what we previously saw. And here we have 51.63. So this just simply enables you to calculate the size of your positions based on the rectangle size. So the size of the stop. You see here we have 25 pips. This enables us a position size of just over 39 lots. So it's a really handy tool that we have available to us. Okay, good. Then we have these. Here we have accumulation bars, and we have price imbalance bars. As a matter of fact, I'm going to change that this minute because I like. Well, I've got you all on here. Develop. I've got a bunch of versions here. Just going to change that because I mean it's important that we know what it is. Enable price imbalance. It's going to change the name of that parameter very quickly. And here we have it. Okay, so now we've changed that because price imbalance. This is very important. Okay, enable price imbalance bars. Okay, we'll start with the accumulation. Accumulation is important because it tells us, rather it shows us visually where, so I'm racing all over the place, but I'll certainly slow down when I'm talking about something that's relevant. It shows us where we have orders being accumulated. So if we have a look at here, you can see that price went down here and it slowed down. It slowed down here. Why did it slow down? It's probably reacting at some area of demand. So it went into here, kind of deep into this area here. Of course, we don't have that enabled. We'll just go like this. We'll just mark off the area like that. So price went into here. You can see when price stops, when it slows down, you'll often see these white bars occurring. So when price comes down to an area of demand, you'll see the candles turning white. And this is because this is the picture of orders being filled. So you have price rallies, accumulates rallies. When it comes down, it feeds into this pocket of liquidity. It starts filling orders, and that changes the attributes of price. And the indicator looks inside these candles, and it looks for a specific structure of the candle, and based on what it sees, it will qualify as it'll qualify a candle as being accumulation. So price comes down, it starts to exhibit these accumulation attributes, then it leaves. It rallies, we accumulate some more, we're accumulating more orders, it flies up, and price will often react at these white candles. And you can see we have some white candles in here. But I mean, these are less interesting to us because context is everything. I mean, this is interesting because of the context. We have price imbalance here, accumulation, price imbalance. So this is a continuation pattern. Price tests the bottom of this area of accumulation. Price cuts through it. So this is supply. This is demand. This area of demand consumes this supply. Price reacts at that area. So this is valid. Price leaves. We come back down to that. We move through it eventually. And the area that caused price to move through this is not this one, but this one, because this, when price left here, we move through this demand. This is the area. So I just draw this very quickly. We have this area like that. Let me enable this functionality so it's easier for us. There we are. So we have this area here. This was taken out by this here. Sorry, it moved here. The point of origin for the consumption of demand is up here. And this is the one we target for an entry. This is where price came to, and now this is currently holding. And so assuming now for a second that price cuts through this supply, and what does that mean? Well, that means that we have demand here that's strong enough to consume liquidity on the opposing side of the market. And so assuming that tomorrow price cuts through that, well, then we would move the rectangle down here. And it would look like that. And then we would trade 72.20 with a 50 pip stop in anticipation that price will react and move higher. So that's what accumulation is. And we have, I think in one of the previous presentations, there's like a Black Diamond FX playlist, and we delved into the details of accumulation. So I recommend you reiterating that, because there's a pretty in-depth discussion of what accumulation is and how it was identified. But I mean, ultimately, I learned about it. I mean, the concept of accumulation, distribution, they've been around well before I even knew what currency trading was. But I learned about it like personally via currency strength trading on the smaller time frame. So I would sit in front of the computer at 8 o'clock GMT, and I would trade currency strength at the London Open. And then I was noticing specific patterns taking place at the open of the London session, and this led me to a study that helped me understand what was going on in these candles. And so this is just the result of that period of study, these white candles here. But the most important thing to remember is that if they're located kind of randomly like this, it's less important. You can see we have really nice efficient trading, and yes, we have rally, accumulation, rally, price tested the accumulation, that worked fine. But this one here is kind of out of context. This one is fine, price accumulated, rallied, we tested that, we went up, we came down, we went up, we came down, we tested this accumulation, this supply. But it's very important that it's within context. Then you have this area of supply. This is accumulation. This is supply. And then price left. What is this? This isn't supply. This is a reaction to supply. And so this is a child, and this is the parent. This is a reaction to this. So the real supply is here. This is a reaction to that. Price came through, we had a small reaction to the child, and then price managed to tear through this and reach the high up here, which is very clear supply. Why is it supply? Well, because we zoom out a little bit, we can do this. We have a trend line. I don't think we got that here. We got a trend line break, which qualified this area of supply. This happened at supply, so price went to supply. We cut through the trend line. We caused market structure to fail. This area of supply did it. This is where we trade. Okay, super. We're almost through. Let's keep going, almost there. And so that's what we have. That's the accumulation. Then we have price imbalance bars. So let's turn off everything. Let's turn the rectangles on again, and we'll enable this. And so what are these price imbalance bars? Well, price imbalance bars they're an attempt to show you where areas in the market where price is out of balance. Okay, what does that mean? Well, that means that you have price. There's nothing here. This is efficient trading. This is nice. This is also nice. When price moves higher and leaves a green bar in its wake, this means that price is potentially out of balance, and this means that price will often return to the source of the candle. You can see here we have one price left. We have a green candle. What does that mean? Well, that means that when this candle closes, price is currently out of balance. It's a disparity, and so in order for price to return to parity, it has to return to the base, to the start of this candle or series of candles. Here we have two, accumulation, two. This is when price returns here, we've rebalanced this price imbalance, so this price disparity, which it did. When price comes back to here, it's rebalanced this one here, which it did over here. We didn't see much of a reaction, but price is ultimately rebalanced. And then price leaves parity in the other direction. Here it was down, and now it's up. And so it leaves a wake of these green candles. So it leaves a string of these green candles in its wake, and this just gives us a visual indication of where we can expect price to gravitate to. Here we have a really nice series of two, green, green. So price will have returned to parity once it returns back to this area, which is accumulation at the base of this green candle. So demand, price leaving, we buy at demand here. And so this is pretty simple. And these are all calculated based on the different time frames. So for the daily, for the hourly, I'm looking at, actually let me, I changed this code today. So for the monthly chart, we're on the monthly chart, we are looking at 12 months. So kind of looking for the range of these candles to stand out in contrast to the previous 12 months. On the weekly chart, we're looking at the previous 4 weeks. On the daily, what am I doing on the daily? On the daily, I'm looking at 5, so 5 days in a week. And so the range is based on a logical average of a certain number of months, weeks, days, 4 hours, so on and so forth. So this just makes pretty good sense. Here, there's another example, price left, we have a green candle, disparity, where's parity? The base of this candle, which is where it came to more or less. Price went down, it's out of balance. When it went down here, it returned to that more or less and came back down and returned to these up here. And it's not finding everything, but here we had one candle, a nice strong push. Here we had two candles. This is stronger than these two candles moving up like that, for example. Okay, super. And then we have, and we're through with those. And then we have the bar object width. This simply specifies the thickness of the accumulation and the price imbalance bars. And then we have the orders. And the orders are pretty cool. I need to open a web browser here to show you why or how I use these. Forex Live. So what I do is I go onto this website and I will go to more, and I'll go to Forex orders. And then I'll go and I'll look for this information here. This guy's got, I think his name is Mike, Mike Patterson. He normally posts these during the London session. He's located in like somewhere in the UK, and he posts these orders. And these guys have connections to floor traders on they're all over the place. And so they're getting a pretty good insight into where these institutional traders have their orders. And so if we look at we're the dollar Swiss franc, let's put that pair on there. Go to dollar Swiss franc, like that. We go to smaller time frame. Let's remove all this stuff here. I'm going to change these colors. So I was fiddling with my template today and things got a little bit funky. bull candle, blue, bear candle, tomato. There we go, it's nice and discreet, good. And so what I do is I go to, let me bring this up. First of all, I'll enable these. Then I'll go to this website and I'll copy these offers. I'll copy these levels here, like so. And these are intraday orders, so these are shorter term, and these are changed every day. And I'll put these in the offers. And you can see there's a setting here, delimiter, and you can see it's a space. What does that mean? Well, that means that the order levels are separated via a space. We have one there which separates the 9780 from the 9800. We have one here. We have another one there. So it's just splitting. This is like a string value for those of you that kind of understand programming languages. It's a string value, and I can split it by dividing it by the value that's in this delimiter here. And we have the bids. Before I do anything here, the bold colors are the ones where there are bigger orders. I paste this in here like so. Then I'll press OK. And then it draws these levels off on the chart. And this is good because when we had these highs and we had this block of orders here was pretty nice. We saw some pretty decent reaction there because there were some big institutions that Mike Patterson is acquainted with, and those traders who trade with them that had orders to sell at this level. And so putting this on your chart just gives you a little bit of insight into where you can expect price to move. I mean, this one held initially. This is from earlier, quite a lot earlier. It went up here, went down to the next level. We came up to the first offer, and now we'll probably move down to this one here because this one is gone. This one is gone. We had the pools of liquidity to buy here, gone. The next level is here. When price leaves here, it'll probably go up to this one. But when it comes back next time, it'll probably come to at least back to this area here. And so this is just a really nice additional tool that I added for this reason. And so yeah, you go to orders.forexlive.com and you can put this information on your chart. And it works for all of the different pairs. And they put on most of the majors and also a couple exotic pairs as well. That's just a nice feature there. And then that's it. And then we're down to the colors. And this simply tells you what color to draw these areas. And we have monthly levels of purple. So when you see purple on the chart, you know that's a monthly area of supply and demand or trend lines. We have weekly, which is orange, daily, which is red, Dodger blue, which is 4 hour, and then you have white, which is hourly. This is good because now I don't even register anything but the colors now. And so I know, great, we have a blue area, I know that's a 4 hour, or if it's a red area, then I know, oh, this is a really good one, or an orange, or this is a whopping weekly area. And so you can trade the areas with confidence dependent on what the colors are. And also you have to allow more flexibility, more room on, for example, monthly and weekly areas, because price come up to a monthly area and it can feed into it 100, 200 pips and then come back down as price accumulates and then go up and then down. And so, I mean, price reacting at purple and sometimes even weekly areas is often slower in contrast to hourly and 4 hour areas. Okay. Well, that was the supply and demand indicator. What are we up? We're up to 1 hour. Does anyone have any questions about this? About the supply and demand tool? Yes, David has another question. No worries at all, David. It's good that you ask. Shouldn't we take the spread into consideration since the candle formation is based on the bid? So we want, sorry, super small writing. So we want to bring our entry point up because I have had a number of situations where my limit order doesn't fill because the candle breached my entry point, but the ask never makes it down there. Exactly. And so when you're buying, you want to ensure that let's assume that we are, let's just take let's just take this. So assuming that we have a 2-pip spread, no, we don't have that enabled. Let's say we have a 2-pip spread. So this is here, so the 96.54. If you have a 2-pip spread, then you want to put your trend line, your entry at, instead of 96.54, you want to put it on 96.56 to compensate for the spread. Because when price comes down here to this level here and you haven't accounted for the spread, then price can come down to your area, but it'll have to come 2 pips lower in order to cover the spread, and so you won't get filled because if price reacts here. But if you put it just above the area of demand, then price will fill you at the appropriate level. So it's a very good point. Excellent, good stuff. Let's a couple of guys here, let you guys in. Okay, cool. Well, Michael, should we cover the currency strength as well? Or do you want to do that at a different time? Let me unmute your mic. I think you've muted yourself. I can't unmute you.
There we go. There I am.
There you are.
Yes, I would say, well, it's 5 p.m. here. You kind of raced through it, didn't have too many questions. I would go for it, Sarita, as long as you're okay. I know these guys will listen to you for hours and hours and hours. So,
yeah, totally.
Yeah, let's introduce it to them a little bit. Yeah.
Okay, super. I'll do that.
Okay.
Okay, so what we have is when we have supply and demand, which is the primary tool that we use, and it's if you ask me, it is the holy grail. It's a phenomenal tool, and it's not a tool. It's an understanding more than anything else. And so once you understand supply and demand, which this software will help you do, then you're set. Then you're completely set. Once you have a really solid grasp on supply and demand, then you'll never look at anything else. You'll only look at price, and you'll have a very solid understanding of what makes price move. Okay, that's technical. Supply and demand is a technical tool. You also have fundamental, which is ultimately even more important. A currency price goes up or goes down. We don't know where it goes. But you want to also have an understanding of why price is moving in one direction in contrast to the other direction. You can see here that price is drifting down. Is it technicals that are doing this? Yes, I mean it is. We have supply. We have a lot of interest in selling the dollar franc at this level here. But this big sell-off here, I mean, this is fundamental here. And so you can either go to business school and learn about macroeconomics, or you can do what I've done, which is take like an express route to an understanding, which actually results in no real understanding at all. It's just a way to interpret fundamental data based on the strength of a given currency. Just to give you a very brief background on myself and why currency strength is interesting, is I've been doing IT security work for about 15 years or so. And so I was really into computer hacking when I was young, and I figured, well, I better get a job. If I don't, I'll end up in jail. And I found a job, and I mean, who needs security more than anyone else? It's the banks primarily, insurance companies and banks. And so I spent a lot of time in banks doing security testing for banks on various trading platforms and other stuff. And I would meet a lot of traders and also people who developed the software these traders were using. And I would ask them what they focused on when they were trading. And I could also see that the primary focus of a lot of these institutional tools was, while there was little focus on fundamentals, there was little focus on technicals, there was certainly focus on major turning points in the market. And I'd speak to the traders, and I would ask them what they would focus on, and the fundamentals, macroeconomics was a huge focal point for these institutional traders. And I'm not a business guy. I didn't go to business school, and I didn't really have an understanding of that. But I kept hearing the health of an economy, the strength of an economy. I mean, how can you assess the strength of an economy? You can look at the strength of its currency, because that's the same thing ultimately. And so I cheated, and I made a tool that shows us this without us having to be economists. So I made some pretty cool tools. I'll just switch it on. It'll take a minute because it has to do a lot of legwork. And now it's showing me the strength of the 8 most traded currencies on all of the time frames that you can see on the MT4 platform. You'll notice, Michael, this is different than the version you're seeing. It's because I'm just kind of fiddling with this new version here. But you can see here we have monthly strength. Here we have 1 minute strength. So you can see here that the 3 strongest currencies on the monthly chart are the British pound is number 1, Swiss franc is number 2, and the euro, which is number 3. And if you look at this pair here, we have the American dollar and Swiss franc. What's the American dollar doing? Well, you can see the American dollar is actually the 6th weakest currency. So we've actually paired the 2nd strongest with the 6th weakest. What should this pair be doing? Dollar franc. It should be moving down as of late. What has it done? It's been moving down very strongly indeed. And so we can see that the fundamental drivers for these 2 currencies are encouraging people to sell. This is due to key economic data coming out of the US and Switzerland, and this has resulted in this currency pair moving down. We have a strong franc and a weak American dollar, prices moving down. I mean, how do we use this information to our advantage? Well, you can pick currencies to buy and you can pick currencies to sell. And so if we look in the middle here, you can see that we have, this is kind of shorter term, so from the daily, 4 hour, 1 hour and half an hour, you can see in the middle here, we have a weak British pound, we have a strong Australian dollar. Well, we did, something changed there. Wait, where are we? Oh, it's because it was downloading data. So nothing's changed up here, but things have changed in the middle here. Okay, we'll go up to here, the most recent monthly data. You can see that we have a really strong pound and a really weak Japanese yen. So if we find the pound yen, this should be moving up. We go to the monthly chart, you can see that we're starting to wriggle up. We had a really nice push and prices accumulating, likely prior to moving higher up to this area of supply. We have, you can see that on the smaller time frames it's pretty weak, which is why we're not seeing a big reaction. But let's have a look, for example, at the euro, American dollar on the 1 hour chart. This pair should be moving down as well. Go here, go to the 1 hour chart. You can see it's moving down really quickly. And this you can see just simply by looking this. So you can look at this information and you can see, okay, well, I want to be selling this currency and I want to be buying this one. And so you use the information available here to pick the currencies that you trade. And you position yourself, rather you find your entry levels based on the supply and demand information that we can see via the supply and demand software. And so it's a tremendous tool. And so a lot of people trade currencies because, they trade currency pairs, a given currency pair, because they're comfortable trading, for example, sorry, I just had a cough there, trading, for example, the euro American dollar or the Australian dollar American dollar. But wouldn't it be more clever to choose the currency pair that you're trading based on the fundamental drivers that we can see playing out by looking at currency strength? Well, I think this would be a pretty good indication personally. And so this is what this tool is made for. And so you can see at the moment it's pretty scattered, it's kind of all over the place. But what you want to see is you want to see on the smaller time frames, you want to see currencies start to turn red, and they'll start to turn red to the right, on the right side of the chart. Then this redness or this weakness will start to spread and move to the left. So when you see, for example, a weak Japanese yen and the strong Kiwi, this might be the beginning of a weak yen trend and a strong Kiwi. And then you want to see this slowly turn red, and then this one and this one and this one, and you want these to start to turn green. And they already are pretty green here on the bottom. This you can see on the 30-minute chart. This could signify a pullback on the 30-minute chart. So the Kiwi lost a bit of, it could be people taking profits on the Kiwi, liquidating Kiwi assets, and looking to buy again once we reach an area of demand. And so the information here is absolutely golden, absolutely golden. But you want to see this, you want to see like pretty consistent readings across some of the time frames. And you want to see, for example, you want to be buying currencies that are 1, 2, and 3 positions 1, 2, and 3. You want to be selling currencies that are 6, 7, and 8, and pairing them accordingly there. So this is a pretty tremendous tool, an enormous asset to your toolbox. But this is one way of viewing currency strength. This shows us everything, absolutely everything. But there's another one that we have, excuse me, and this is a different representation of the same information, but it is only visible on the time frame and the currency pair that we look at. And you can see here that when price is moving up like so, when we have the histogram above the 0 line, you want to be buying, and when you see it below the zero line, you want to be selling. And this is pretty interesting for other reasons than that. If any of you are familiar with the term divergence, this is just a really good tool for that. And there's actually some pretty good examples on the Aussie. We can see here that when price came down here, it was reacting on major demand back here to the left. It came down, price was going low. We had lower lows and lower highs, but the currency strength was not supporting that. So we had the low here, and then the next low was here. I mean, is the currency strength divergence supporting that price moves lower, or is it starting to turn around? Well, you can see very clearly that we can actually see that the Australian dollar is gaining in strength in relation to the American dollar, or you could say that the American dollar is depreciating in strength in relation to the Australian dollar. And you can see this very clearly here. You can see that this is the picture of price seeking liquidity to move price higher. The clue is given when you look at the histogram just here. This is empty selling. This is empty selling. This is price being moved lower artificially to find liquidity to drive price higher. And you can see that here. This is what's going on here. You can see we had the similar thing happen. Here we had price was moved, oops, wrong tool. Price was moving lower here, but it was doing the opposite here. Price went higher. You can see this everywhere. You can see that price here was moving higher into supply, but we did not have this being supported in the strength. Things were equal here. Then price sold off. And you'll see this absolutely everywhere, and it's a phenomenal tool for that reason alone. So you can use it either for divergence trading. Here we have another one. We have another one here. We had like a less aggressive increase in strength on the Australian dollar. We had a nice sell-off. So you can use it for that. But you can also, I mean, you can see, sorry, I'll just do one more and then I'll leave it. You see them everywhere. So you can use it for that, or you can use it to trade in line with strength. Let me delete the objects here. And so you can go on, for example, the daily chart, and you can say, well, I want to trade in line with the daily histogram. You can see here that we are above, so we want to be buying the Australian dollar, American dollar. And you go to the 4-hour or the 1 hour, your entry time frame, and you find somewhere to buy. And then you use the supply and demand software to help us find a nice area. And you can see that we have a nice one just here. Price has pretty much already been there. We kind of touched these wicks here, reacted these wicks, and this is where we saw the buying. The price could easily move down here. We probably have, let's have a quick look, find the source of these, some price imbalance. Here you can see we have price is still imbalanced, and it'll rebalance once it gets back to here. So price could easily kind of dip down into here, around here, before it turns around and continues higher. And this would be trading in line with the daily strength. And so all of this, I mean, you could have been trading long from here to here. just looking for places to continue to buy. But when you see price going down like that, then it's a sign that we're having, this could easily be, for example, divergence on the smaller time frames up here towards the top. When you see that, then you want to be very, very careful buying against divergence, because divergence normally happens really, really quickly when prices just dump, boom, like that, or move higher like a rocket. So just be careful with that. And I mean, initially, I recommend that, excuse me, that you leave the histogram on the chart, and you don't use it to make trading decisions, but you notice what it's doing when you're making trading decisions based on supply and demand. And this will be a tremendously insightful test and a little project for you. I've been doing that, and it's a really powerful tool. Yes, so I mean, we have those two. We have the dashboard, which I'm currently improving, and then we have this histogram here, which is something that you apply per chart. Supply and demand. Yes, so this is, I have like a chart here, and that's a little bit cluttered. Let me clear that up. Like so. Turn these on. And just notice what price is doing. You can see this is that Australian dollar one. You can see we had this weekly demand. What does that mean? That means when price gets there, it's probably going to slow down. And so if you're short, you want to take profits before we get down here. Also notice that we have a price, this really strong move lower that we can see in price is not supported in the histogram. It's much less aggressive. When price comes down here, we see price really quickly beginning to retreat already on here, which means that it's time to get out of the trade or consider buying. And you can see this very clearly using these tools. And so, I mean, all of the tools are very visual. They're pretty intuitive. And my most important piece of advice would be don't overcomplicate it. Just look at the tools, take the information that it's telling you away and apply it to your trading decision making. And I think you'll do just fine. But don't overcomplicate it, because there are a lot of rectangles here, and there's a lot of stuff going on. What should I do? I mean, this one is here and that one's there. And yes, it can be a little bit complicated, but initially on demo accounts, I mean, just see, you can see that we have demand here. The histogram slowing down. Just buy it. Just get in the trade there, and just buy it, and watch price as it goes up. See what the histogram is doing, and just pay attention to all of the information that you're being shown by the software. And I think that your hand will be guided very clearly and very neatly if you pay attention to the software, and you really try to avoid overcomplicating things. Yeah, and eventually, once you're familiar and comfortable with that, then you can go on to, we've done some really nice supply and demand presentations that you can review, and they really help drive the whole supply and demand theory home. Initially it'll sound a little bit complicated, but it's not. I'll tell you one thing: trading is absolutely not rocket science. It's super simple, but it's like crazy difficult to do. And the crazy difficult to do bit is the human behind the keyboard who's trying to apply this really simple strategy. It's simple, and it needs to stay simple. And the point where it becomes difficult, then you'll find it's a personal struggle. It's either a struggle with confidence, with the fear of losing, with the fear of not being right. So maybe a little bit of ego in there, or the fear of something else, of being forced to make decisions in an environment that is uncertain, which is a difficult thing. It's just like being in a situation where you have to make a decision to protect someone you love in an environment that's really unsure. Okay, we're faced with this fear. Should I go left or should I go right? You don't know, but you have to make the decision. And so just make the one in trading that feels most natural. Use the tools as a guideline. It's like, I mean, before you're walking down the road and the lights are turned off, the software turns the lights on so you can see where you're going. It makes the path a lot clearer. And so just, I mean, Michael, He knows how to use these tools very, very well. I wrote the tools. I know how to use them well as well. And so just contact either Michael or myself, and we'll gladly clarify any trouble you're having. But I think if you're having troubles applying the tools, it's probably related to some kind of a psychological bump in the road, and these can also be dealt with. So there's nothing to fear. And again, with repetition comes confidence, and with confidence becomes superior trading. And so I recommend just getting your hands dirty, engage in the market, feel the fear of engaging in the market, and watch what happens. Even though you're fearful. I mean, fearful does not mean that there's danger. It just means that you're insecure about a situation. Danger is dangerous. Fear is not dangerous. Fear is just our perception of something that we think is dangerous, but it doesn't have to be dangerous. Trading isn't dangerous. It's just fearful because we can lose money, and that's also uncomfortable. And so I really recommend just taking as many trades as you can that are qualified trades that you can, just so that you can kind of get the method and the use of the tools under your skin. And I think in relatively short order, you'll be doing just fine. Okay, good. Michael, do you have anything you'd like to add? I can't hear you. Not sure if... Let me see if I can unmute you. Yeah, and so, I mean, I'll wait for Michael to jump out there and see if there's anything. But I mean, we do have these three tools. We have the supply and demand software, which we've looked at. We have the dashboard, which gives us a really nice overview of what these currencies are doing in relation to one another. Then we have the histogram, which is a really nice currency strength tool that shows us what's going on a specific chart, on a specific pair. And they're phenomenal tools. And it looks pretty much like the tool moving average convergence divergence, or the MACD, and it's showing similar information, but the information that you're seeing here is being drawn on all of these currency pairs. It's a tremendous amount of insight that you're gaining simply by looking at the histogram. It's drawing on a huge amount of information, and it's provided in a really intuitive and simple format, which makes it great, which makes it super good. Okay, yeah, Michael's he's on the telephone. Okay, Rakesh has a question here. I'll just run this through. He says, it seems like parents can become child levels, and child levels can become parents aside from the original parent level that caused the initial move. How would you know what child parent level to take? Also, it seems like child levels hold in the short-term trends, and the original parent level causes channels. It seems like parents can become child levels, and child levels can become parents. Okay, so that's the same question, maybe asked twice. Yeah, well, let's kind of cover that really quickly, Rakesh. Let's go to the 4-hour chart and let's have a look. And you can see, and we have, I mean, most importantly, it's really important that we don't really kind of overcomplicate the notion of parents and children. The only reason I use that terminology is because it illustrates that there's a relationship between the two. And so we have this one here, and we have this one here. This one is reacting to this one, which makes this a child and this the parent. If this is reacting to something else, which it is, then this is a younger sibling and this is the older sibling. I'm so sorry if this sounds confusing. It's just the way that I've explained it to myself so that I can understand it. Okay, and so you can see that this is actually not a parent. This is a child, because this is reacting to the same level as this child, and this is the parent up here, which is just here, and this is what they're reacting at. And so a child is ultimately an area of supply and demand, is a reaction that is a reaction to supply and demand. So these are less important areas of supply and demand. and these are more important because these are individually established, independent areas of supply and demand. Like all-time highs and lows are typically apparent supply and demand, or continuation patterns like this one, or we have another one, a really nice one on the CAD that we spotted like a year ago. This one here, we were like, we were selling up here ages ago. I don't think the indicator is, yes, we were selling up here ages ago. This is a monthly level, only 264 pips, and look what it did. This is a really nice parent supply, and this is supply. Why? Because it was strong enough to consume opposing demand. And we have this area here, which was tested by this. So this is the parent, this is a child. This area took out both the child and the parent and everything else below. I don't have any more price below, sorry, historically than here, but you can see that, I mean, when price left here, it destroyed everything. And it all originated from here. This is where price tested. This is where we saw the reaction. And so we just want to, let me find something where we don't have any orders. And you can see that we have, I mean, there's this parent-child relationship everywhere. We have this one here. This one managed to move below this pattern here. This is a child. It's reacting to this one here, and this is reacting to something in here. You can see simply by the structure of these candles in here that there's something going on in here. You can see how price went up, it pulled back, and then it went up again. So there's micro demand in here at this level. We'll draw a line in there like that. And so price, you can see the upper side of it is probably maybe around here, which is roughly where price came back to here and here. Price cut through it, we had a small reaction, and price dug down and went to this monthly demand that has been drawn. It poked into this monthly demand, and then it went higher. On the way up, we established this child monthly demand, and this is still untested. And so depending on how these areas are formed, you can take them or you can't take them. And one of the other presentations that we've done, these are all recorded again in the Black Diamond FX playlist. We go over quality considerations for supply and demand. And so, I mean, the indicator is going to mark off a lot of areas for us, but not all of them are beautiful areas that we'd want to trade. It's showing us most of them, and then we have to use our own discretion to qualify these areas of supply and demand as valid supply and demand. And we go through this discussion in the one of the videos. Okay, David is saying, I hope I answered your question, Rakesh. It helped clarify some things there. David is asking, perhaps they are saying that the child that develops over time ultimately develops trend lines and the market structure. But once the market structure breaks, the child turns out to be the parent upon reversal. So if you have, so for example, if we have like a trend line break here, a trend line breaks and it comes back up here. Yeah, well, I mean, parents and children, a child will always be a child because a child has reacted to something else. So once it's a child, it's always a child. But a parent, I mean, parents can, I mean, then again, if you look to the left, I mean, what's established historically is already established. So if this was a parent, it will always remain a parent, but it can be an area of demand that has been tested once, twice, 3 times, and so this parent becomes disqualified based on the quality considerations that we touch on in the video. You can see, I mean, the first time back is the best. This was kind of a little bit shallow. Price came out. This is the first time test. This is the best. We saw a nice reaction. Each following time reduces the likelihood of this area holding in the future. But this is apparent, and it'll always stay apparent. It can be apparent that has been disqualified, and once price moves below the low, then this is no longer apparent. It's just actually it's an invalidated area of parent demand. So parents will always be parents, and children will always be children, if that makes sense. And no worries at all, absolutely no worries at all. And like I said, it sounds a little bit confusing, but it really isn't. It just takes a little bit of chart time. It just takes a bit of chart time. Let's see. That's nice and clear. And so, I mean, if we have a look at like just some setups, you can see that. I mean, currently, let's go to the daily chart. You can see that this pair is moving pretty much sideways. We're reacting. And here again, an example of me drawing it like that. As a matter of fact, I would draw it like that. Why? Because when price establishes area of accumulation and it left, you have to look at the price, the price level the price came back to before it left, and it's here. As a matter of fact, it's here. So ideally, on the next test, you don't want to pay a price any more expensive than $99.50. And where did price come back to? Well, it came back to, let's have a look, $99.47, and we're on a daily chart, so there's 3 pips of drawdown, which is great. Price left, we had a really nice rejection, and when you see children reject like this strong and do damage to the structure of price, we have a downward sloping trend line. This qualifies something in here as demand. We go to the 4-hour chart, we have a look. You can see that we have this one left, this one left, this one left. This one here looks fine, but you can see that when price established came down here, you can see price came back to a low. So I'm going to have to remove these rectangles so we can see. You can see what I'm talking about. False. So you can see that when price came back, it came back to this level here. So price has already been back to the low of this candle. So you don't want to be paying a price any more expensive than the 99.62 on a test of this. This is also the one that caused the break. Oh, so I can get the trend line, mark it up here. Come on. Let's remove that. So if we mark it, we can mark it like that, because that's pretty much where it goes, like that. And so this is the area of demand, the point of origin of demand that caused market structure to break, or fail rather. Price rallied, we accumulated just under the trend line, and then it cut through and went north. And this is where it originated from. I mean, we had a 14 pip stop, and prices have gone to the moon and back since then. So that's I mean, just a really good example there, I think. Let's see, what else do we have? You can see here, we're on the Aussie CAD. This is fine. Go to the daily chart and have a look. You can see that for this price structure, price didn't take this out when it left here. If price would have taken that out, this here, I would have been really confident about selling here. I'll still probably sell there if I traded the Aussie Canadian dollar, but I would like the road to be cleared in the opposite direction. And so now we have to watch for opposing areas of demand that are going to prevent this trade from working out. And ideally, you want there to be at least a 3-to-1, a 2-to-1, 3-to-1 risk reward. So the size being 2 to 3 times the size of your stop. So assuming that we get in here, we want it to be at least 100 pips away, which is there. So we want to clear road from here down to here. This is going to get us our 2-to-1. So if price moves up here, we have a nice price imbalance, lots of green candles up to here, then we're going to sell here because we can expect price to return to parity, which is going to be at the base of the green candles, maybe somewhere down here. Also in anticipation that price is going to move through this area of demand because it's been tested once and twice. And then we have other areas to consider, excuse me, down here. So we have this here. This is where price came back to, like that. You see price went up, then it poked in there. And then you see we're reacting on this demand here. This is kind of like the top area of demand, which is up here, which is here. Because this, and it looks like I just put that on there because, hey, that's where price came to, but there's a very, very clear reason. This candle left is the body of this candle within the range of the previous. No, it's not, it's above. Is the body of this candle within range of the previous? Yes, it is. Is the body of this candle within range of the previous? Yes, it is. Is the body of this candle within range of the previous? No, it isn't. So our area of accumulation is from here to here. So this is actually the area. Where did price come to? Came to the 98.50 area, almost to the pit. Let's see what the low was. The low was 98.51, and we had this at 98.49. So we had 1.5 pips of drawdown on this test here, which is tremendous. And price also, when it left, you can see the green candle. This would have been a green candle. Let's just enable that, just so you don't think I'm making this stuff as I go along. This is the green candle, and this shows us where the edge of the area is, because this is where it released. So that's where you want to buy. Stop 72 pips, and you want there to be at least a 2-to-1 from your area of demand to opposing accumulation or supply, which is, we have, price has already been back to here. So there's something going here. So you want at least a 3-to-1, or 2-to-1, sorry, up here. And so if we drew this whole area off, you could draw like that, something like that, and that's where you would want to be out of the trade. And so you'd want at least 142 pips from here to here. We have 217, so that's perfect. That was a really nice example. But it's, as you can see, it's pretty simple. It's not rocket science. It just takes a bit of practice, I think. Good. Well, does anyone have any questions about the stuff that we've covered? We've been going for about 1 hour and 40 minutes now. I don't know if Michael's still on the telephone. He wants to add anything before we wrap up. David is asking, what hours of the day do I trade? Because I'm on the higher time frames, I'll trade all the time. As a matter of fact, I don't really spend a whole lot of time trading. I do my analysis, I put in my order, and I walk away, and I don't do much else. And then they're filled normally, I don't know, maybe 1 trade a week or 2 trades a week, depending on how many pairs I'm currently looking at. But this is how I like to trade. I like to go to the higher time frames because I'm not interested in the news. I don't want to be on the 50-minute time frame, because then there's a very high likelihood that you're going to be shaken out of your trades due to economic data releases, which is a blow. And so I like to move higher. This also synthesizes the news. It kind of dissipates when you go up to from the daily and higher. Rakesh is saying here, when you look at the bottom left indicator, do you look for X amount of green red arrows to determine the side of the trade you will take? No, I don't. I don't look at that. What I normally do is I'll look at, let's find a clean chart. Let's look at this one here. What I normally do is that I will, let me enable these. I will look at the green candles in order to assess if price is balanced or imbalanced. So it's price at parity or disparity for a current price structure. You can see here that when price left here, it was out of balance, and now price is rebalanced. It's returned back to the base of the green candle, the accumulation at the base. So now you have to look up and you say, where do we have green candles to the upside? We have one here. So we can expect price to go back to here. Above that, we have here, which is this area of accumulation. So, this is rebalanced. And so on this time frame, on the 4 hour, we can expect price to leave now and go up to, around here initially. If you go to the daily chart, maybe price needs to rebalance on the greater period time frames. And you can see here that we had this green candle left. It's rebalanced. We move deeper and deeper still. So this is pretty much all rebalanced. Price left here, it's rebalanced. So you go to the weekly, what's cooking there? You can see that price still needs to come back down here, which it hasn't done. It's come pretty close. If you look at the lows, so let me get that out. And we've come back to the low of this release, which is nice, but we still ideally need to come back in here somewhere. But it looks pretty rebalanced, I'd say. If price comes back down to here, then you buy somewhere down in here in this monthly demand and wait for price to rebalance to the upside. And where would that be? Well, that would be somewhere up in here, this area of opposing supply here. And so that's what I normally look at. And that's on the weekly chart. Then you go to the monthly and you can maybe see a completely different story. You can see here that, wow, the monthly chart is, we have this up here, prices left. It's a disparity, parity is up here. So we can maybe get some kind of reaction down here and then follow price up to around here, at least up to there. And then look at this. I mean, price is really out of balance. So in order for price to return to parity, this price structure is going to have to move up to around here. So that just really helps you kind of keep on the right side of the market at least. Any other questions before we wrap things up? I don't know if how's Denmark? It's actually really, really nice. The sun is shining, and so we're not wearing thick winter coats anymore. It's really good. He lives in Vejle, does he really? That's incredible. What on earth is he doing in Vejle? Yeah, he works for Lego, of course. Yeah, funny. Incredible. That's funny, David. Is there any special correlation between price imbalances and the accumulation? Well, yeah, there is. We discussed a little bit earlier that, I mean, at the base of these green candles, ideally you want to see like one or more, maybe one to five white candles. Sorry about that, bit of a yawn. And so, I mean, ideally you want to see something like this, and you want to see accumulation just at the base there. And this shows us that when price is out of balance, then you want to kind of look for an area to buy at the base of this. Keeping in mind where price is moving on the higher time frame, you can see that we're drifting lower here. So we're in a downtrend, and we have this one here. So we have an accelerated downtrend. So you've got to keep this in mind. So when price comes down like this, just keep in mind that you'll be buying counter trend, because you should be focusing on short term. So sorry, on selling. And also here we have an upward sloping trend line, which is broken. So this is pretty bearish price behavior. Yeah, so you want to look for, I mean, areas of accumulation that come before these green candles. Here we have a child, we have the parent. This is actually a reaction to this. So this is also a child test. So here we have some white candles up here. And this is where price is reacting at. We reacted once, twice, and now price came down to daily, so we're expecting it to move higher. So yeah, ideally you want to look for those white candles and use those as, give you an idea of where price will likely come back to. And you normally draw the rectangle around these white candles. But there's a lot of, we go into a lot of detail on that in the supply and demand video that's in the Black Diamond FX playlist. My pleasure. Actually, I just want to unmute you quickly so I can, if you would like, just say your name so I know how to pronounce it. Just going to unmute your microphone. Now I can hear you. How would you pronounce your name?
Elias.
Elias?
Yes.
Cool, very nice, beautiful, very, very nice. Thank you very much. I just don't want to, because I know that of all people, I have a pretty strange name, and sometimes your name gets butchered. Elias. Okay, good. I can say that very nicely. Excellent. Well, hey, it's a great pleasure, Rakesh, an absolute pleasure. And I hope I pronounced your name correctly. Am I saying correct when I say Rakesh? Excellent. Perfect. I'm very pleased. Super. Michael, are you around? Are you still on the telephone? If you're still on the phone, I thought maybe we can wrap this up, because I think we've covered the majority of the material.
Sareed, you there?
Yes, I'm here.
Yep. I'm on a phone call with a gentleman, but I've been listening to you. Are these guys doing good? Are they doing good?
Yeah, I think so. I think
Fantastic.
They're doing incredibly good.
Fantastic. I hope they're better than me, Sareed. I don't even know what happened on FOMC today. I don't even look at the news anymore. I don't even know what's going on anymore.
Yeah, it's a good point. I mean, it's not even in. I don't know. Maybe some people think it's interesting. I'd rather not spend too much time sitting in front of the charts. I do it anyway for software development reasons, but trading, I don't want to spend too much time sitting in front of the charts. And if you're trying to follow all the news events and make head and tails of what they mean and how they should affect market prices,
Exactly.
I mean, honestly, you have a better chance predicting the weather, I think.
Exactly.
You can get good news coming out of America, and it can be incredibly bearish for the American dollar. And it's a bit like, why is that? Well, that's probably because that data point was not what the Fed was focusing on. But I mean, how do we know? And
right.
so it's
just
best to focus on price.
All right, I'm gonna go back to my call, Sareed. All right.
Sounds cool. I'll wrap things up here.
Thanks again. Thanks, Sareed.
Hey, always a pleasure, Michael. Cool. Steve is saying here, when will you be coming to Philly? Well, actually, I'm coming to the US this summer. We're spending a month in the US this summer, my wife and my two boys, and we're flying to Seattle and driving through the mountains to Montana and then up through Canada to Vancouver. So that'll be pretty amazing. But I've never been to Philadelphia. Maybe I can come out there and visit Michael and you guys one day. That'd be tremendous. Sounds like a pretty cool city. Yeah, that'd be super cool. But yeah, I think we can certainly do something like that in the future. I think Michael's able to recruit a bunch of really motivated, excited people who want to learn how to trade currencies. So I think we could probably get like a pretty good crowd. So maybe it'll be in line to come and do like an intensive workshop or something. That'd be tremendous. Yeah, Vancouver sounds amazing. I really look forward to getting there. It looks like such a modern, beautiful city on the water there, on the forefront in the mountains in the back. It looks incredible, absolutely incredible. Cool, excellent. Well, I think I'll wrap things up so we can keep this under 2 hours. I'll make a recording. We're recording now. I'll publish the recording and I'll push it out to the playlist, and you guys will all have this for your for viewing at a later stage. And I want to thank you all so much for being here. And if you have any questions about any of the material we've covered, please feel free to drop me an email. I'll just put my email address in here. There you are. So you can write to me or Michael, and we'll get your questions answered, and I'll get back to you just as soon as I can. Well, I thank you again. Thank you everyone for being here and taking the time out to listen to me ramble on about this software and trading. And I look forward to seeing you all in the next webinar. And until then, have a super day and a weekend when you get there. And we'll speak soon. Thanks so much for being here.